these young borrowers are in for a very rude awakening. Nobody cares. So on September 1, the billing cycle starts. On October 1, the first payments are due with interest, by the way, that accrued from September 1 to October 1. And if you don't make your payment, it is going to have a dramatic negative impact on your credit scores.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm your host, Kerry Lutz. It's a big day on Wall Street, big day for America. Credit card balances, receivables have just hit the $1 trillion mark. And 1 trillion to me is the definition of a bubble. Our good friend, Paul Oster, is with us now. And Paul, it's great to have you back on the show. If you've got a question for Paul or myself, just shoot me an email, kl@kerrylutz.com. And hey, Paul, it's always great to have you on. If people want to reach Paul, you find him at betterqualified.com. Paul, you are our resident or non-resident credit card expert. What do you think the significance is of that milestone?
Well, there's two parts to it, Kerry, and unfortunately, not only are the balances on our credit cards, it's more than creeping up. I mean, we're amassing debt now that we haven't seen since the Great Depression, not the last recession, depression, whatever you want to call it, back in 07, 08, 09. We're back to the Great Depression, relatively speaking, in terms of people drowning in debt. And you just had the New York Federal Reserve release a survey on credit card delinquencies and auto payment delinquencies. So when you couple that together, all it means is that the average consumer is now, they can't afford to pay their bills and they're starting to drown in debt. And let's not forget, September 1 starts the billing cycle again for student loans.
Student loans, right.
And there's a large percentage of those student loan borrowers who say they're not going to be able to make, the first payment.
Mm-hmm. Right. So they can't even make the first payment. And so these people are going to be, they're going to pretty much have their credit wrecked, aren't they?
Yeah. So, this thing has a lot of legs. So what happens is, along with credit card balances, your credit score, your income has nothing to do with your credit score. Your credit score is based on a couple of different factors, but one is payment history, makes sense. The second one is your utilization ratio. So the credit bureaus don't know how much money you make. What they do know is how much credit you have and how much credit you are using. And once you go over the 30% rule, your credit card balances are 30% more than your credit limits, your credit scores start to come down. So we're already seeing that, in our line of work here. Unfortunately, our clients' credit card balances are going over the 30% mark. Credit scores start to come down, and they come down quickly. They go over 50%, 80%. If you go over your credit limit by $1, right? Okay, let's say you have a credit card, you have $1,000 limit. If for whatever reason, at some point, you go over that, you put $1,001 on that credit card, your credit score could easily drop 50 points, maybe up to 100 points. And now if you throw in delinquencies, a 30-day delinquency, 50 to 100 points easily, especially the younger the borrower or the consumer, the greater the impact is, because you have what's called a thin credit profile. So if you have a long, storied credit history, you have numerous accounts have been opened and closed, you have a great credit history, a one times 30-day late payment may only cost you 30 points. I say only with, a grain of salt. But, yeah. But if you're a young credit profile, a thin credit profile, it could easily cost you 50 to 100 points, which now can keep you from getting approved to go buy a new car. It keep you from getting approved to go buy your first home. Everybody wants to be a first-time home buyer. It's the American dream to own your own home. But that comes at a cost. And all of the things you see now, the Federal Reserve continues to raise rates. Who knows what's going to happen at the next meeting? But every time they do that, our credit card interest rates go up and our 30-year fixed mortgage interest rates go up. But when you hear that the new mortgage interest rate is 6.5%, that's for people that have a 740 credit score or better. If you're a 720, if you're a 700, a 680 credit score, I don't like to use bad and good credit. I just say, you're less than excellent, less than perfect. You have a lower credit score. I don't want to say a 680 is a bad credit score, but what I will tell you is it's going to cost you a lot more money for every other financial transaction. Mortgage interest rate, you're not at 6.5 at a 680. You could be at a 7.5. Insurance policies and premiums are directly tied to our credit. They don't call it a credit score. They call it an insurance score. It's the same damn thing. So especially, when it comes to insurance policies and premiums, especially in the Northeast, you could be paying 90% more for the same coverage. If someone has excellent credit, 740 or above, and somebody has poor credit, let's say a 640, a 620, 90% more for the same coverage, 90% higher premium. So your credit score is going to cost or save you money every single month, every single day for all of our financial transactions. Unfortunately, right now, what we're seeing, and it's so funny, this, They've politicized this thing, and it's become more and more confusing. A month ago, they were telling us how robust the consumer index was, and they were still spending money. The economy's great. No, we weren't spending cash. We weren't spending money on our debit cards. We're putting money on credit cards. So again, it's just an early indication, and I've been saying this now, unfortunately, for the past year. This is just the beginning, and we're going to start to see because there's a lag time and a little bit of latency, and now we're starting to see it. Foreclosures are creeping up, pre-foreclosures, 30-day mortgage lates, auto payments, credit cards. Credit cards and auto payments, they're the really early indicators. But what's going to follow is your foreclosures, your short sales. People are going to get in trouble with their house soon thereafter. So we're in for a bit of a bumpy ride here.
Bumpy ride? Can we say you're calling for a recession or even worse?
Well, I'm just going to say it's going to be a bumpy ride. So whatever happens, forget about the macro economy, right? I mean, we have pressures from the international platform is not very stable right now. We have a lot of issues all over the world, coupled with what's going on right here in the United States. Again, I don't want to put a moniker on it, but we're in for a bumpy ride.
All right, so we're in for a bumpy ride. How do you get through it? Because you're a problem solver.
Yeah.
People come to you not because you're a good-looking guy or because you're a good person, but they come to you to solve problems, right?
Yeah, it's a great question. And what I tell our clients now is you have to focus on what you can control, because all of the other stuff, let's face it, is out of our control. So what can we control? We can actually control our expenses. We can't even really control our income. Maybe it is time that you start looking for a second gig, for the next 6, 12, 18, 24 months, maybe for a couple of years.
Or a third.
Yeah,
or a third, right?
A third job. Yeah, that's right. And look, there are people out there that are juggling 3 different jobs, but you know what? They're paying their bills on time. So, you might not have to do it for the rest of your life. And you probably only have to do that because you don't have that 12-month emergency reserve. And if you don't have that right now, maybe you take every extra dollar that you make. If you work a weekends, you're going to work a couple of nights. Every single penny that comes in from the second gig goes into an emergency reserve fund. If you don't have that, that's how you get through a recession. That's how you get through the bumpy ride. You have to have some type of backup, because if something happens during the downturn, what are you going to do? You're going to turn to a credit card. You're going to take out some kind of crazy personal loan that's, at 30% interest rate. And that's how people really, get in trouble, unfortunately. So you get a second gig, or again, we can't really control our income if we can't get a second job, or certainly ask for a raise or get a better job. We have to cut expenses. And it's really hard to get Americans to change their behavior. And a lot of times it's too late. They change their behavior when they're in the crisis mode. But if I could just get consumers to understand, again, I'm a realist, I get it. But maybe instead of, going out to dinner every single week, you cut back to twice a month. Maybe you cut out the convenience store on your way to work, and you only hit it on your way home, or maybe you only hit it on the way to work to get that cup of coffee, $4. You wind up not finishing it. But if we can change our behavior before this gets too bad, those are the ones that are going to be better off in the end, because there's going to be a certain degree of people that have to file bankruptcy at the end of this whole thing. And then there'll be a group of people, they don't have to file Chapter 7, they file Chapter 13. So I always look, like you're saying, at what is the solution, and how do we get through this with as little negative impact? So a Chapter 7 is kind of absolutely the worst case scenario. A Chapter 13 is a little bit better. Maybe you have to go through a credit management program. Maybe you have to do a little bit of debt consolidation. But if you don't change your behavior, right? Freud said it best: continue to do the same thing and expecting different results would make you insane. So if you don't change your behavior, then you are going to get the same results or worse. Because let's not forget also, in the middle of all of this, interest rates continue to go up, cost of goods and services. So now we have inflation on top of everything else. The average household paying $500 or more for the same goods and services that they did 6 months ago. So change your behavior, cut your expenses, and figure out how you are going to get through this, because the government's not going to help you through it. The banks aren't certainly going to. No one really cares, right? So it could be the worst recession in the world. Bank of America, Citibank, Chase, they don't care, right? So you can't call them and say, but you saw the news, the Fed keeps raising the interest rates and the inflation, and they'll go, if you don't pay me by the 1st, I'm going to report you to the credit bureaus.
Right. There's no way around it.
Right. Or they're going to send you to collections. And it's the same way with student loans. These young borrowers are in for a very rude awakening. Nobody cares. So on September 1, the billing cycle starts. On October 1, the first payments are due, with interest, by the way, that accrued from September 1 to October 1. And if you don't make your payment, it is going to have a dramatic negative impact on your credit scores.
Hey, so what's a good credit score to have these days?
Well, the best is 740 or above, right? So it's called tiered based pricing, and it happens with any type of underwriting and financial obligations. When you apply for financing, it's tiered based pricing. So 740 or above. Yeah, look, the cost of money, all money costs money. So what it's going to cost me to borrow money at a 740 or above, I'm going to pay the lowest amount. My cost will be the least amount at a 7, and so it goes from like 740 and above. And if you go backwards, if you're a 720 to a 739, you might pay an eighth of a point higher. Now, on a small type of financing, maybe a car or something like that, it might not be that dramatic. An eighth of a point on a mortgage of $200,000 is a lot of money.
Yeah,
then
sure.
Then it goes 700 to 719. you're going to pay more. 680 to 699, you start paying more. So once you get below a 660, let's call it, that is what's considered subprime borrowing. You're going to get, you're really going to get hammered with fees and deposits, and it's going to cost you that much more money in your overall annual percentage yield for sure.
All right. So so basically you gotta get your act together. You gotta confront the ugly reality, whatever it might be. And then you gotta go do something, right? You gotta take action, whether it's budgeting or whatever.
Again, being proactive and taking action. I tell everybody, if you don't have a financial planner on your side right now, maybe you go get one, or you use one of the softwares that are out there. But here's, and I'm not a certified financial planner, but I will tell you personally, what drives me crazy is you have people that are putting money into a retirement account. And right now you're actually, earning a little bit more than you normally would. But let's say you're earning 5%. But people who are putting money into a retirement account while they're carrying credit card debt and paying 30% on that debt, that does not make sense mathematically. So maybe you pause your contributions into your 401k or whatever, or your Roth IRA, whatever you're doing. And hopefully you have the ability to do that, but you pause those contributions until you pay down your credit card debt. Look, even at 7% interest on a mortgage, if you could do a cash out refinance and consolidate all your other debt, and then you only have one long-term debt service at 7%, that might make sense also. So people, like you just said, you have to take action. If you just sit back and let this thing, barrel you over, you are going to be roughed up. You're going to be bruised up a little bit at the end of it. So do something now, be active about it, be proactive, call the creditors, call your mortgage company, call the loan servicing company. And for any of the young people, if you're listening, there's only one place to go for information on your student loans, or maybe you're a parent who co-signed for your child. It's studentaid.gov. Studentaid.gov. We already see the scams. The CFPB released a report the other day. They've earned companies millions and millions of dollars. Unfortunately, borrowers have already been scammed out of millions and millions of fees that they've paid to companies that promise to help them. So only go to studentaid.gov. That is where you're going to get the most pertinent information regarding your student loan, or pick up the phone and call your student loan servicing company. It may have changed, by the way, in the past 3 years. Do not wait until September. So look, that's right around the corner, right? So maybe today is the day that you actually do something before September. And if you haven't done it, do it sooner than later, because they will be inundated. When these first payments actually come due and people can't make their payment, you will have much better success if you do something right now and reach out to the servicing company.
That makes so much sense, Paul. I think that is the best piece of advice that you have given us today. And look, these are hard times, no question about it. And the ideal is never wait till you need a favor. Ask for it when you think you don't need it, right?
Yeah, I always say, you cannot borrow an umbrella when it's raining. So reach out to somebody now. But here's the other side of it, because again, a lot of times, unfortunately, Kerry, when I'm on, I'm like the doomsayer. But the reality is that we have gotten through every other situation before. I've been doing this for over 20 years. You've been around for a while. We'll get through it. It's just a matter of how we get through it. And I never want someone to feel that they're so overwhelmed with debt. Look, unfortunately, it's tragic. People commit suicide because of debt, and that should never happen. It should never, ever happen anywhere in the world. and certainly in the United States, because there is a way out of debt. Always. We have to be disciplined. We have to figure it out and put a plan in place. If you just let this thing kind of unfold, if you don't take any action, again, you can expect to really start to feel some pain in a very short period of time. And how long that pain lasts is going to be determined by what action you took before this thing really starts to spiral out of control. So again, control what you can control. You can control your income to a point. You could ask for a raise, you could look for a better job, you can get a second gig, but what you can really control are your expenses. And if you just started to cut out some subscriptions, some conveniences, some recreational things, some lifestyle choices. Yeah. So
get rid of your cable. You don't need it anymore. And you can find virtually every program for free these days. Maybe not exactly the day you want it, but it'll be there.
And if you had a goal, if you have to sacrifice something that you really, really want, then you put a goal in place and say, in 6 months, I'm going to get it back. In 12, 18 months, 24 months, I'm going to get it back. Look, when I talk about those timeframes, that's a blink of an eye. Think about what happened in the past 2 years, 12 months, 8 months. Right. Those are blinks of an eye or even faster. So put a goal in place to get those things back if you really need them. It's really the stuff that we want, not what we need. But be disciplined in your approach here. Get out of debt. If there's any way possible, you can get out of credit card debt that's costing you 30%. So I think you and I have spoken about it. You want to earn the highest return on your money. If you have credit card debt, pay it off. Because paying down debt that you're paying 30% on is like getting a 30% return on your money. And there are no markets in the world right now that are offering a 30% return.
Guaranteed. That's a guaranteed return too.
Exactly. Right? There's no risk. Every single dollar that you pay off in credit card debt will give you the exact interest rate that you were paying on that money. So try and get out of credit card debt as quickly as possible, or at least stop the bleeding, cut the cards up, freeze them. Again, reach out for help. Look, if you come to betterqualified.com, all we try and do is give you some options that you'll have to choose from. Is it debt consolidation? Is it credit management, credit counseling? Is it credit repair? Is it bankruptcy? Or are there just a few things that you would have to rearrange, in your debt servicing that would help you out? But do something, right? So if you want to start by going to betterqualified.com, our consultation is absolutely free. And at the end of the consultation, at least you will have the options that are available to you, and then you make the decisions on how you want to do it.
Hey, if you want to get out of a hole, the first thing you got to do is stop digging, right?
That's right. That's right.
That's really the key. Well, appreciate you coming on. Hey, betterqualified.com. That is where you find our good friend Paul. I mean, we've been talking for over 10 years, Paul. We've seen a lot of ups and downs here. And the key is plan to get through it. Don't try to white knuckle it, because then you're going to be living in fear. I mean, the biggest problem I see, and I think you'll agree, is people go into a fear mindset, and then every call, every knock on the door, you're scared to death, right? So the key is get out of the fear mindset and take action.
You're absolutely right. There's no reason to live in fear or to live with the mounting pressure of the debt. Once you take the first step towards getting out of debt, every single client for the past 20 years has said the same thing. I should have did it 6 months ago. I should have did it 2 years ago. Yeah. It gives you some type of freedom and relief to start moving in the opposite direction. And the first step, as with every single thing we do in life, the first step is always the hardest. Just take the first step. And the other thing, like we had said, Kerry, it's not as bad as you think. It really isn't. It's never been worse than somebody thought. Typically, people come in, they just have the worst expectations in the world, and they say, "Wow, okay, so this isn't going to be that bad." In 12, 18, 24 months, maybe sometimes 6 months, I'll be okay. Yeah, you're going to be fine. But just now you have the plan, just execute it and be disciplined. That's it.
All right. Hey, we appreciate you coming on. BetterQualified.com. Go over there now if you're having any credit issues or you think you might. Hey, if you think it's going to be bad 6 months down the road, call Paul now. It's that simple. Appreciate you coming on. Hey, if you've got a question for myself or Paul, KL@KerryLutz.com. That's the email address. When you're at the site, financialsurvivalnetwork.com, just click Paul's link and it'll take you right over there and sign up for your free newsletter. Paul, always a pleasure. Keep up the great work. We'll talk to you again soon.
Okay. Take care, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.